Welcome back to another in-depth video where we dive into everything happening with SoFi stock. Today, we're discussing groundbreaking developments and the latest data behind the scenes that you need to know. If you've been following SoFi, you're aware of the roller coaster ride over the past few months. We've seen incredible growth, followed by calculated manipulation designed to stall the momentum. Let's break it all down and uncover the truth about what's driving SoFi and what's holding it back. Hello everyone, welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But before that, alert, this is not a financial advice video. First, let's address the elephant in the room: short interest data. This data, updated every 2 weeks, is a critical indicator of market sentiment. Over the last several months, shorts have been covering their positions at a rapid pace, indicating growing confidence in SoFi's fundamentals and a weakening of the bearish narrative. Why are they covering? What's driving this shift? The answer lies in the consistent performance of SoFi's management and its business model. For years, SoFi endured relentless attacks from short sellers who pushed a fabricated bear case built on shaky grounds. These narratives have been systematically dismantled by the company's strong quarterly performance. As a result, we've seen the stock surge over 100% in the past 3 months. Shorts are left with no choice but to cover their positions, and that's reflected in the numbers. Let's take a closer look at the short interest data. On August 31st, there were approximately 189 million shares sold short, with the stock trading at 7.99 cents. 2 weeks later, that number decreased slightly to 186 million shares. Fast forward to October 15th, and we see 180 million shares sold short, accompanied by an uptick in the stock price. By October 31st, short interest dropped to 166 million shares, with the stock climbing further. By November 15th, short interest fell dramatically to 148 million shares, and as of the most recent update, it's down to 136 million shares. This represents a significant decrease, with shorts covering over 44 million shares since the summer, driving the stock up by over 130% during that time. This trend clearly shows that the short bear case is unraveling, and institutional investors are stepping in to take advantage of the opportunity. However, there's more to the story. Over the past 2 weeks, we've witnessed what can only be described as deliberate manipulation by major financial institutions like JP Chase and Bank of America. These institutions have issued downgrades and neutral ratings on SoFi, citing overbought conditions and inflated price-to-earnings ratios. While these headlines may appear legitimate on the surface, the timing is suspicious. These institutions seem to be working in tandem with short sellers to create fear, uncertainty, and doubt, FUD, among retail investors. Why would they do this? The answer lies in their conflicting interests. While these banks hold positions in SoFi, they're also aligned with short sellers. By issuing downgrades during a December rally, they're attempting to suppress the stock's momentum, allowing shorts to cover their positions and institutional buyers to accumulate shares at lower prices. This behavior highlights the power dynamics at play on Wall Street, where the interests of large financial institutions often conflict with those of retail investors. Despite these efforts, SoFi remains undervalued. Analysts have lowballed their earnings per share (EPS) estimates, with most projecting numbers well below management's guidance. SoFi's leadership team has forecasted EPS between 55 and 80 by 2026, yet analysts have consistently underestimated this range. For example, Bank of America recently projected 52 cents EPS, a figure that could easily be doubled based on SoFi's current trajectory. This discrepancy underscores the flawed methodology used by some analysts to calculate SoFi's valuation. Another factor contributing to SoFi's undervaluation is its unique position as a one-stop-shop fintech company. SoFi is not just a bank. It's a comprehensive financial platform with the potential to revolutionize the industry. Its Galileo technology, often referred to as the AWS of fintech, is a game-changer that could be licensed to major financial institutions across the country. By 2025, we expect SoFi to land significant deals that will solidify its position as a market leader. SoFi's management team, led by CEO Anthony Noto, is laser-focused on achieving long-term success. Noto's incentives align with shareholder interests, as he stands to earn a substantial bonus if SoFi's stock price hits $45 by 2026. This alignment of interests is a positive signal for investors, as it indicates that management is committed to driving the company's growth and profitability. Looking ahead, the upcoming CPI report is another key factor to watch. This report will provide crucial insights into inflation and its impact on the market. While we may see short-term volatility, it's important to keep a long-term perspective. With no significant tax loss harvesting expected this year, any dips in the market are likely to be driven by profit-taking rather than panic selling. This sets the stage for a strong Santa Claus rally that could carry SoFi and other growth stocks higher into the new year. Institutional ownership in SoFi is another bullish indicator. Over the past year, we've seen a steady increase in institutional buying, with holdings now exceeding 540 million shares. This trend is expected to continue, with institutional ownership potentially reaching 600 million shares in the coming quarters. As more institutions recognize SoFi's potential, we're likely to see further upward pressure on the stock price. However, it's important to remain vigilant and question the narratives being pushed by legacy media outlets. For instance, a recent $19 price target upgrade by Jefferies analyst John Hecht received little to no media coverage, while a $12 downgrade from Bank of America was widely publicized. This selective reporting creates a biased narrative that benefits large institutions at the expense of retail investors. By staying informed and critically analyzing the information we receive, we can make better investment decisions. In conclusion, SoFi is a company with tremendous potential, backed by a strong management team and innovative technology. While short-term volatility and manipulation may create challenges, the long-term outlook remains incredibly promising. As shorts continue to cover and institutional investors increase their positions, we expect SoFi to reach new heights in the coming years. SoFi's journey is far from over, and there's still much to look forward to. With the company on track to achieve full-year profitability and significant growth in its core businesses, the future looks bright. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.